Welcome to Real Estate Investing for Women. On this show, you will learn how to create wealth through real estate the blissful way. That means with very little stress and very little time. We talk about strategies, mindset, heart set, money smarts, resources, and so much more to ensure you're able to create the success you most deeply desire. Now, here's your host, Monica Sawyer.
Ladies, today I am really excited to welcome back to the show for the third time, Kaaren Hall. And for those of you who have not heard her shows before, let me give you a reminder of her bio. So this is what we have. Despite being in the midst of a recession and mortgage market collapse, Kaaren Hall founded and made a resounding success of uDirect IRA Services. She discovered a strategic way to put her 20 plus years in mortgage banking, real estate, and property management to use. The solution was an untapped market for both her skills and for investors, self-directed IRAs. Through uDirect IRA, she has guided tens of thousands of Americans through the process of diversifying their investments using self-directed IRAs with $1 billion plus under management. Learn more about Kaaren and their thriving company at uDirectIRA.com. Kaaren, you're being very distracting.
Oh, I'm so sorry. It's just, you have to have fun. You know what I mean? You have to have fun because it's serious business. So we just like to keep it light.
So ladies, you should have seen, like, if you go to YouTube, you could probably see her like with all her cute little hand motions. It was very funny. So good. How are you?
Oh, I'm doing super good. Super good. I saw you recently. That was lovely. And yeah, just all's well. And you?
Really, really good. So ladies, just so you know, Kaaren is incredibly generous with her time in her business as well as in her personal life. She's been putting together these boss lady retreats for some of us ladies that don't have the time to do stuff. She just puts it all together. We show up and we just have this luxurious time with all these really powerful women, but we don't talk business, right? We're not there to talk shop. We just kind of hang out and get to know each other's heart. So it's been so much fun to hang out with Kaaren and some of the other ladies that were there. And then also she invited me to this formal event where I got to dress up in a beautiful gown. Who gets to do that? It's so like much fun. Oh my God.
Like, look at your closet. How many gowns do you have? People don't do gowns, but
we don't
do
gowns.
Fun.
And it was so much eye candy there with all the men in tuxedos. Oh my, it was so good. So we had a great time. So that was just a few weeks ago. So it's so nice to connect with you again.
Yeah, you too. And I'm really happy we can be talking now because, you know, the IRAs are they've always been a really hot thing. And there's just some new stuff on the, you know, on the griddle, if you will, or some metaphor, you know, coming up. So it's a good time to talk about it.
Well, why don't you start with that? That's a great lead in.
All right. The griddle of IRAs. Let's go. All right. I don't know.
Pizza
it's the only thing that came to mind, like a flat surface. Okay. Well, with self-directed IRAs, I mean, when, you know, you read my bio and you talked about like an untapped market. Well, in 2009, it was an untapped market, you know, and so many people had no idea what a self-directed IRA was. But these things were created, the IRA in general was created in 1975, okay? I mean, it was probably before you were born, right? I'm just, you know, right, literally.
I wish.
Yeah, well, you know, just say yes. Just say yes.
Yes, of course.
Yeah, of course. Yeah, me too. And so it's been around so long and it's really tried and true. But in 2009, all of a sudden, it's recession time, no money, you can't get a loan from a bank. Banks were really, you know, especially for real estate investing, because it was such a tough time then. That's when I opened uDirect. And I think people really discovered the self-directed IRA like they know it now. That's when they discovered it because they could tap into other people's IRAs to raise money for their deals.
Right. And I just want to interject one thing here that I've done every single time you talk about this. I just want to put it in here too. A lot of people say, oh, but I've got a self-directed IRA because they've got it with Fidelity or Vanguard or whatever, right? They let me direct as much as I want. They let you direct on certain vehicles, usually mutual funds. They will let you do some REITs if you're interested in real estate. They'll mostly stock. So kind of like stock market type vehicles. They won't let you invest, for instance, in real estate. And so what Kaaren is talking about is a true self-directed IRA, because you can invest in other things that are not stock-based, right? So that's the big differentiating factor between a true self-directed IRA and I've got a self-directed IRA in my 401k, right?
Right. Well, I mean, it is self-directed. You think like, and IRAs are IRAs. An IRA is like a bucket that holds assets. So what makes it self-directed is the asset you choose. Just like you said, I mean, when you talk to your financial advisor, they are licensed, and you know this, you are licensed. And if you're licensed to sell, market correlated assets, and that's it. You can advise on that, but you can't advise outside of the market, the stock market. So we're all about the alternative asset. And what makes it self-directed, of course, is that you're choosing the asset. We're not telling you what to invest in. So we don't offer anything for sale. It's truly self-directed. So, but I'll tell you, but back to the recession, it was it was so great to see and really witness the grassroots level of capital raise. So there was a huge need for capital and a huge need for projects, and so many houses that needed to be rehabbed and fixed. And one of the solutions was IRAs. And so IRAs were kind of a grassroots person-to-person way to rebuild our economy. And when you consider in retirement accounts altogether, there's like nearly $40 trillion in retirement. 40 trillion.
Wow.
That's an enormous amount. So let's put that money to work, making everything better. Like my business, my IRA loans your business some money. Your business pays my IRA back the loan. My IRA purchases a house. The renters pay the rent to my IRA. And of course, there's private placements, there's precious metals, there's so many different kinds of assets, right? And so that's when it really came to the forefront, I think, in most people's minds. But self-directing's been around a long, long time. And as you and I were chatting about off camera, not a lot's changed in the 15 years since I've been in the industry. I mean, a few things have. A couple of case laws have passed, kind of drawing lines, because the IRS doesn't always make things clear. With the IRS, it's always, it depends.
Right.
So we've received in 15 years just a skosh, of clarity from them, but hardly any. But again, it's largely unchanged. But we are looking at a couple of possible changes, again, on that griddle of IRAs. So one of them, and this has got bipartisan support. This is called the Secure Act 2.0. So I think the biggest thing that we'll see coming out of this Secure Act 2.0 is an increase in the RMD age, required minimum distribution age. Okay, so why do you care? Like, a big deal, right? Well, this is why you care. So if you're at a level where you need to take money out of your IRA, that's fine. But if you're at a level where, you know what, I'm doing good, I want to leave my money in my retirement account so it can continue to grow because I don't need it today, it allows you, I mean, it was 70 and a half, and then Secure Act 1.0 passed, and then it became 72. But it's going to go to 75. So your money can continue to grow all those years before you're required to take it out. Isn't that great?
Yeah. And so this is the key. And I think we get a little bit confused about it, that people don't realize that in IRAs, there is a required age. Like if you're 70 and you're still working or whatever, you don't need all that money, you're still required to take out a portion. Now it's 72, you said. Yeah. And I have known many people who are like, I don't want to take it out yet. I'm not ready. I just want it to keep growing. Yay on them, right? At 72, that they're like, I'm still going strong. But the government didn't give them any option. And it sounds like now there's a possibility of a new option, which I love. So that means you can take it out like younger at 70. Is it 59 or what is the lowest?
Well, okay, 59 and a half is when you can take it out without penalty.
Got it. Okay, so that's when 70, you can start if you want to.
If you want to, but the required minimum distribution is you have to.
Right,
of course. So that brings up another good point about the Secure Act 2.0. So if like today, if you take money out of, if you forget your RMD, that's what I'm trying to say. If you forget your RMD and you don't take it, the penalty is 50% of what that RMD would have been. It's so big.
Ouch.
Right?
Oh my gosh.
it's really bad. So what the 2.0 is looking to do, and it's in writing, we'll see how it comes out. Secure Act 2.0 would lessen that penalty to probably 25%. That's what they're talking about. So I know RMDs are probably far off for a lot of people, but this is important maybe for your parents, maybe for your other family members that have to take this money out.
Mm-hmm.
It's really good to know that things are going to become more lenient in that regard, and I'm really happy about that.
Well,
I think,
Also, when you're deciding where to put your savings money or your investing money away, those are things that you're going to consider, right? If I want full liquidity and full control, I may not want to put it in an IRA of any sort, right? And IRAs have limits on how much you can put in, all of that stuff too, right?
Yeah.
So as you're making your financial plan for your future, some of it you're planning for retirement, some of it you're planning for cash flow and for today and for vacations and for life happening, right?
Yeah.
But so which portion do you continue to put into your IRA, and how do you decide to utilize like that? How much are you going to prioritize that? And the more flexibility we have on that, the more likely we are to prioritize that as a possibility. Wouldn't you agree?
Oh, completely. And what you said brought up a point is that, you're using that money, and when you're investing using an IRA, the reason you do it, why do you do it? Why would you use an IRA? It's because of its tax protected status. Mm-hmm. So if it's like a SEP or like a traditional IRA or a 401k, chances are then it's tax deferred. You're not paying tax until you take the money out. If it's a Roth, it's tax free, assuming you meet two qualifying conditions, like being 59 and a half and having a Roth for 5 years. So it's the tax treatment. And that's the reason you use an IRA to invest, because you're not going to pay the tax in a typical kind of IRA, and in a traditional or SEP IRA, for example, until you actually take the money out.
Right.
So you can make a huge killing, but then maybe you bought a building, 1 year and 10 years later, you sell it. Maybe you made $100,000. We don't need $100,000 today. You need 10 grand. You want to take out 10 grand. So you don't have to pay tax on that whole, cash flow experience.
Right.
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 It's just the amount that you need. So you pay the tax as uDirect.
It gives you a little bit more sort of, when you're putting your financial plan together, it gives you more control, which for me, I'm all about choice. Like, I want control over my money. That's what it's really all about for me. Right. So choice in life, choice in my money gives me choice in life. Right. So.
Absolutely. Plus, when you contribute, a lot of times, unless you make too much, you hit like a certain amount, you can also perhaps take a tax deduction for your contribution.
Yeah.
And by the way, this year, or coming up in 2023, the contribution limits just really went up. I think because we see inflation, but we saw the biggest increase. Like if you have a solo 401k in 2022, the cap, it's either 25% of your income or $61,000, the lesser of. That's a 2021 contribution, or what year is it?
It's
COVID
2022
just messed with
right
my
now.
brain.
But yes,
Thank you.
This will be going out in 2023, just so you know.
Okay. In 2022, the contribution limit was a lesser of 25% of your income or $61,000. That's 2022. Mm-hmm. You can make that 2022 contribution all the way until your tax filing deadline, and there's an end on that, but you can do that and make a prior year contribution. Now, for 2023, here's where the contribution limits really, really had a very surprising increase. It went up $5,000, which is very unusual in this arena. So now it's 25% of your income or $66,000, the lesser of. Mm-hmm. So if you have a solo 401k, that is a huge advantage to you to be able to contribute, $5,000 more, and hopefully, most likely, get a tax break on that.
Yeah, I know a lot of people listening do not remember what a solo 401k is. So could you define that real quick?
Sure. Okay. Well, we know what a 401k is at work, right? Mm-hmm. It's a plan. It's a savings plan. And unlike an IRA, this is a 401k. It's a different animal. It's the same purpose, but a different animal. And so an IRA is one thing, like a SEP, which is a simplified employee pension, is an IRA. It's one thing. But the solo K is two things. It's an employer portion and an employee portion. Okay. So it's two buckets. And if you're self-employed with no full-time employees in any of the companies that you own, then you can have a solo K, then you qualify for it. And now you can contribute more. So again, the two buckets. So the employer and the employee bucket, or we call it the plan and the participant. So in the participant portion, which is the smaller portion, that can be all Roth. That's one of the great things about the solo 401k. Other great things about a solo 401k, if you qualify for it, is that you can take out a plan loan. You can actually borrow from your solo 401k for your personal use, maybe to buy a personal home or take a vacation or pay for college or whatever, but you must pay your 401k back over a 5-year period, either monthly or quarterly at a market rate. So it's like a little investment, like yours. The loan turns out to be an investment for your plan, but you can have that for personal use, and it's huge. You can't do that in an IRA.
Mm-hmm.
Other benefits. If you have an IRA and you want to invest in real estate, great. So many people do. If you have a solo K and you invest in real estate, also great. But if one of these accounts wants to take a loan, it's a solo 401k that is not subject to the UDFI tax for an acquisition loan. Okay. So we all love the power of leverage, don't we? Like in our personal lives, leverage is yay. But in an IRA or 401k, typically, the proceeds that the account earns because of leverage are subject to this UDFI tax. But if it's for acquisition, then this solo 401k has an exemption. So that's another great thing about the solo K.
Tell me about that tax.
Yeah, the tax. Okay, so we'll break off solo K for a second, because it's a really great account. Again, if you're self-employed and have no full-time employees, it's the bomb. It really is. So the tax, there are 2 times an IRA can be taxed. You know, we use IRAs, 401ks, and all these plans to save on tax. So it's not income tax. It's UDFI, UBIT tax is what it is. And so if you want to read about it, just real quick, you want to jot something down for our listeners. It's irs.gov, publication 598, and you can go deep there on Pub 598, okay? But what it is, say for example, again, we'll just use simple numbers, like you purchase a house, your IRA purchased a house, and it's $100,000. That's great. And so your IRA, you only had $70,000 to put in, so you borrowed 30. So 30% of that acquisition cost is leveraged, okay? Now your renters pay the IRA the rent, let's say the $1,000 rent on that $100,000 house. So 30% of that $1,000 was earned because of leverage, right? So it's that 30% that was earned due to leverage that's subject to the UDFI tax, unrelated debt financed income tax.
Interesting.
And I'll tell you what, yeah, and that's, we're talking about your IRA owning a house and a renter, but here's another situation where UDFI tax comes into play, and it really catches people by surprise. That's private equity, right? So you invest at your IRA. Now, if your IRA loans money to a private equity capital raiser, that's different. But if your IRA has an equity position, an ownership position in a private equity, and that asset sponsor is taking a leverage in the deal, and part of the money your IRA earns is because of the leverage the asset sponsor took, you're going to owe UDFI, and you might not know it. So that's one of the things, like when you do your due diligence on a private placement, always read it. Always have your attorney review it, always. But take a look and see, is this asset sponsor taking on leverage? Because it's not the end of the world. You know, when you file a 990T, which is the tax form, you get to take deductions. So maybe there'll be no tax at all. You still have to file. So maybe it's just a wash and it's not a big deal, but you want to know, because if you need to file the 990T and you don't, the IRS will come knocking eventually and say, hey, why didn't you file a 990T? And they're going to know, because the asset sponsor is going to issue a K1 to you. They share that K1 with the IRS, and the IRS knows, okay, red light here, this is what we should expect. We should expect a 990T because there was income earned because of leverage. A lot of people don't know that.
Yeah. So Kaaren, that was an awful lot of really, really good information. It blew up my brain. Can I ask some questions?
Oh, please do. Yes.
Okay. So let's say, for instance, we have a lot of boss ladies that do syndication. So let's say, for instance, we invest with one of our ladies. Many of them, their minimum is $50,000. So my listeners, you kind of know what we're talking about. Let's say you put $50,000 in a syndication deal, right? It's got a 5-year span. Your preferred rate is 7% or whatever. Your IRR is supposed to be whatever it is, right? We get our K1 every year. Talk to me about how that, let's actually get specific. Like, how does that work? I know you just explained it to me, but let's break it down a little bit more so I can understand what you just said.
Yeah, well,
Is that okay? I know you're not a tax consultant, so I'm clear about that. But what you said was really interesting, and I'm afraid I missed something because I'm in that situation, right?
Okay. Well, like some of our friends, I've invested with them too, but I've invested as a note investor, like a lender.
Yes.
Right. And so I don't have to worry about these taxes because I don't have, my IRA doesn't have an equity position. My IRA is the lender and it's different.
Okay.
Okay.
So you're not you're not a preferred partner. You're just carrying a note.
Well, I'm correct.
Because I'm trying to figure out, like,
I like to think I'm preferred.
In the verb, yes, you are preferred, but you know what I mean? Like the way that they'll say like a preferred, your preferred investors, or I don't even know what, but there's something, your preferred rate, right, is 7, 9, 10%, right? And then they are going to refinance and give you back your capital and then some, and then you get part of their rent every month. And then eventually they're going to sell and you're going to get some of that equity. And then you have a gain because you've taken depreciation. There's all this good stuff, right? So that's
the beauty of making money right there.
Yeah. That was pretty cool, right? But but so when you say that you're just carrying a note, is that not the same of what I just said?
It's similar, but I don't have an equity stake.
Okay, got it.
I'm a lender, not an equity owner.
Okay, got it. Okay, so that's also interesting. But as an equity owner, for instance, like what I've got going on, how does that translate? Do you know?
So if your IRA is an equity owner and your IRA earns money because of leverage, then it kicks in this UDFI tax.
Okay.
So it's a tax on, basically unrelated income tax, because anyway, it is related to investing. I don't really quite get that definition, but it is because you're investing, but that's what it's called. It's the IRS, go figure. So the thing of it is that if your IRA earns capital due to leverage, so it's not money that you contributed, it's not money you saved. You're not earning a certain percentage of that return because of your savings. You earned that return because of the leverage that the asset sponsor took out.
Got it.
And it's subject to the tax. And so you would talk to your tax advisor, show them the K-1, and have them file a 990T.
But that's only if it's invested with an IRA.
With a retirement account, correct. Okay. That is retire. I'm all in the bubble of retirement accounts. So that's all I speak on is inside the bubble.
Yeah. Okay, perfect. Okay, interesting. I didn't know all that. That's really cool.
Well, and it's a good thing to look for because so many people are caught unaware.
Right, of course. Okay, good. So, and then what are some of the other things? I know I interrupted you so much. So
it's okay.
What were some of the other things you were headed towards?
Oh, it's hard to remember, but just to say, we talked about the Secure Act and what's happening with RMDs and the possible changes. I just think that, I think too, well, when you and I were at this event, we heard economists speaking about what's on the horizon. Now, nobody has a crystal ball, but it certainly could lead to perhaps lower priced real estate again. We might see that again. And if we do, that might be a good time to acquire real estate again, because obviously buy low, sell high. I don't think that's giving investment advice. I think everybody kind of knows that. So we may have an uptake in people investing in brick and mortar, sticks and bricks kind of real estate again, and having tenants and going through that. So why don't I talk a little bit about what it's like to own real estate in an IRA?
Please, that's what I was going to ask. Yes, tell us how that works.
Because you know how we buy a stock, we go online and, we just kind of, that's what I do anyway. I click and, I want, this many shares and boom, it's there, right? No problem. But buying a house is first buying a house. Say that's what we're doing here. You got to go through escrow. You got to blah, blah, blah. You got to do all that. Title. You just can't get away from that part. But your IRA comes in with the money. And if you need leverage, we talked about the non-recourse loan that your IRA would take to borrow money. So now we're there. We're at the closing table. The offer has been made in the name of the IRA. Either you have leverage or you don't, or maybe you've got two partners buying it together concurrently, perhaps. And now you're ready to close. So great. So now you close on real estate. Yes.
Hold on, just one thing. So ladies, I just want to clarify. So let's say, for instance, we're talking $50,000 again. You're buying a $200,000 piece of property. You put in the $50,000 from your account, but you know that controls now much, much more, right? Your 25% controls 4 times as much in the asset. That's the way real estate leverage works, right? So she's talking about basically, and there's a special kind of loan that can be given to an IRA that's not given to the rest of us. And that's what she was referring to when she said
non-recourse loan.
Non-recourse loans. So those are the kinds of loans that you can get if you want to invest if you've only got a certain amount of the value of the property to invest.
That's right. And so, and then, yeah, so it kind of threw me off, but that's true. So you've got this property and you're buying it. We could go off on so many rabbit holes,
yes,
but I'm going to stick with it. Okay.
Yes, go ahead.
So now your IRA owns either 100%, say it owns 100%. You didn't use leverage. It just bought 100%, bought the building straight out with your savings, whatever kind of building it is. Now, what do you do with it? Because there are things called prohibited transactions. So you've got this property in your IRA, but what you can't do is, hammer the nails. You can't do the work yourself because it's called an overcontribution of sweat equity. It's a prohibited transaction, which is something you want to avoid. That's why we always talk to people. We give a free consultation so we can talk to you and say, tell us about your deal and help you learn how to avoid prohibited transactions, right?
Okay.
So you're not going to do that. But what you can do is you can still hire third-party vendors. You can select the property, obviously, and close on it and do all that without it being sweat equity. You can vet the renters in the property, and you can hire third parties to do the work, and without it being considered sweat equity. So you're kind of allowed to property manage, but what you cannot do is take any kind of fee from your IRA for anything, including property management for an IRA on property.
Okay.
But that's great because, your IRA is there, you've got, tenants and you've done your homework and you've got a cash flow going, and you can really use that cash flow to build your retirement. All expenses have to be paid for by the IRA, and all proceeds have to go back to the IRA that actually owns that asset. So that's how that works.
Okay. So for instance, let's say you put in all the money from your IRA, and now suddenly you've got some maintenance things. A fridge goes out, the sprinkler system breaks, something happens, right? But all the money from the rents has been going into that IRA. So you've got this extra money now that you can utilize for these other pieces, these other things that you have to do. It comes up with real estate, right?
That's right. And so that's why we ask our account holders to leave a 10% pad in their account, because you don't know what you're going to need.
Yes.
And of course, the closing costs, right? The rehab, the property tax, that new refrigerator that you need for your rental, and it has to be a rental property. You can't have any personal use of it.
Right.
All those expenses have to be paid for by the IRA. So you really, really need to leave a pad. So let's talk about what happens if you don't have enough money.
Yes. Let's talk about that, because that's what everybody is thinking.
Yeah. So there's a few things you can do. You can write a check and contribute to your account. That's probably everyone's first go-to. Now your contribution depends upon your age and your income and your account type, but there you go. You can write a check and contribute. Now, maybe you already made your contribution. So what can you do then? Well, maybe you've got another IRA someplace. So you liquidate that to cash, send the cash over to the self-directed IRA, make it up. You could take on a debt partner, somebody to give you a non-recourse loan to your IRA account so that you could then, come up with the money to do what you needed to do if you had to. But if all else fails, you'd need to sell the asset. If you didn't have enough to really cover the expenses, you need to sell the asset because you can't pay for those things personally.
So when someone gives you a non-recourse loan to make up the difference, are there certain percentage restrictions? Does it have to be another IRA that's making that loan? Tell me a little bit about what that other loan might do, because that's interesting. I've never heard that before.
It is. And by the way, so we're talking about, non-recourse loans. So let me tell you that if anybody would like a copy of my list of non-recourse lenders, it's not people I necessarily endorse. It's just as a courtesy. But if you want that list, I would be very happy to send it to you. info@udirectira.com. There's my mail push. udirectira.com. And there you go. I'll send you the list. But it could be an individual. It could be a bank. I mean, I don't know if a bank would make a loan if you're really in a hard place, but doesn't have to be IRA money. It can be somebody else's personal money. But what it can't be is a disallowed person. So it's not going to be a lineal ascendant or descendant, right? So parents, grandparents, you and your spouse children, grandchildren, they're not going to be making this loan. It's also not going to be a 50-50 business partner. They're disallowed. Or any fiduciary, like maybe your real estate agent or your CPA, somebody who has a fiduciary duty to you or to your account or to this asset. They would be barred from doing that. But you can have a third party make a non-recourse loan to your IRA.
Okay. Interesting. That's interesting because that gets us out of trouble in a situation like that.
It might be the final straw. That would be my last go-to.
Right.
But it's available. Yes.
Okay. Interesting. Perfect.
So now we're in real estate. Now we've bought the property, and really it's the whole lifespan. And let's just talk about the timing of the lifespan of something like this, because that's something people always wonder, how long will it take? Well, we know how long real estate takes, so let's just put it there, right? Real estate is an imperfect world. It's always, I'm sorry, but it can also have a glorious outcome, but in some way it's going to be a train wreck at some point along the way. Because it's a house.
It just happens.
It just happens.
I don't like to call it a train wreck. There are definitely challenges and tears, but
challenges and opportunities. That's what it is. Challenges and opportunities.
That's right. That's right. Yeah.
But just to say that, you're going to have the pitfalls. So you want to know what to expect. So first you open an account. That's the first thing. So how long does it take? Maybe a day. You fill out a form, you give us, a setup fee and your ID, and there we go. You've got an account. Boom, done. 1 day max. The second step is putting money in that account, funding it. So you can contribute, make a contribution. You can do a rollover from a previous employer plan, like you're moving the money from that previous employer's 401k, 457, 403b. Great. That takes about 2 weeks if it's a previous employer plan. Or you transfer an IRA to IRA transfer, which usually is much faster than a rollover, usually like a week tops. So you fund it. Now it's open and funded, then you invest. And you select the asset that you want to invest in. Could be precious metals, could be private equity, could be a loan, so many different things. But you give us we call it the supporting documentation, which is just a general way of saying the contract. There's some agreement, even if it's an invoice, to pay a vendor, or if it's the actual note and deed of trust for a secured loan. Whatever the documentation is for that asset, you give that to us, along with a simple, really quick form, like who are you, what do you want to do, and how much, and all that. And then we review it. Then it goes through a review process. And we say 3 to 5 business days to make that happen. Oftentimes it happens a lot faster. The majority of the time it happens a lot faster. Sometimes more, but mostly a lot faster than that. So then there you go. So you open the account, might take 2 weeks to fund it, but while we're waiting for that money to come in, we're reviewing your documents, getting everything all queued up so that you're ready to pull the trigger when the money comes in. And then, we'll send a check, we'll send a wire, and boom, you've self-directed. That's how that works.
And that's true for real estate too. So I've heard that to buy real estate, you have to open up an LLC in the name of the IRA.
Right. Okay. Well, that's an excellent topic. And I've got a lot to say about that, but that's called the IRA owned LLC, as you probably heard it called the checkbook IRA, right? Mm-hmm. Yeah. It's not really what it is. People get the misconception that when they open a self-directed account, that a checking account comes with it. Mm-hmm. That is a misconception. That is not how it works. So you have a retirement account, all right, that's self-directed, and you open it and fund it. Then you have a third party create a special purpose LLC. Now, you're not going to do this yourself. People will say, oh, well, I have a 401k, we'll just put it in there. You can't use the LLC. That's what I meant to say. You can't use the LLC that you created yourself because you own it, and your IRA cannot purchase an asset you own, right? So it has to be a third party that creates this special purpose LLC. Mm-hmm. So the IRA is open and has money in it. The IRA buys 100% of the initial units of that special purpose LLC, all right? And the money goes from the IRA here into the LLC's checking account. So your IRA is like the umbrella, and your LLC sits under the umbrella. The IRA owns the LLC. And that's how you can have checkbook control of your IRA funds. Now, it can be very handy in some situations, especially when you're investing in tax liens that are very transaction intensive, when you're buying properties at auction, where you have to have the money right now. There are some really useful purposes. But you don't have to have the LLC to purchase real estate. Now, you'll hear some attorneys say, hey, it gives you great asset protection and it does this and that. And that all may be true. Of course, I'm not a lawyer and can't give legal advice, but people will do it for that reason too, and to separate out their assets. So there are a lot of reasons to do that.
But that LLC is also, like, I live in the state of California. Every single LLC gets taxed $800 every single year. That continues, right? It's not like it's exempt from that because
Correct.
it's owned by an IRA, right?
Absolutely right.
Okay.
For the privilege, but nobody else has that high a tax, you know, an annual fee. I mean, there are some states that are, but that's another good point. So I think, well, I don't like this $800 in California. I'm going to open a Delaware LLC for my IRA.
Right.
But guess what? You still have to register it in California.
You
Still
do.
pay Delaware and California.
That's right. No,
And
I found
sometimes
that out the
that's
hard way.
Yeah. And
Yeah.
sometimes it's worth it to people to do that, because what you're doing is a lot of people do that to protect their assets. And that's a great conversation to have with your asset protection attorney.
Mm-hmm. Perfect.
Yeah.
Awesome. I love all of that. Thank you for that. And I think the idea, so I will just say, one of the questions or comments that I get from my ladies is like, I just don't understand it. And I think when people are confused, they don't move, they get stuck, right?
Yes.
And so some of this stuff helps us to mitigate that feeling of not really knowing. But what would, excuse me,
Yeah.
Kaaren, what would you say to people that are hesitating? For instance, my husband's like, no, I think I'm just going to keep it all in the 401k. I understand it. I'm good. He's got some rollover money. We were talking about self-directing it. He's like, nah, I just kind of want to do it this way. And I think there are a lot of people out there that are like that. They just don't understand it. And they're afraid to move everything over, roll it all over. Right. So what would you say to those people, Kaaren?
Well, I would say that you probably want to have a return on your investment. You want your money to grow, right? Mm-hmm. So then you take a look and say, well, how can I make my money grow? And so say you decide you're going to invest in, maybe I'll throw it out there, private equity, like a Reg D offering. Now, whether you do it personally or in an IRA, you can still make the same return, correct? Mm-hmm. If you do it in an IRA, that return is either tax-free or tax-deferred. So that's one reason to use a self-directed IRA, because assuming you've got those two buckets of money, the personal money and the retirement money. Mm-hmm. But if you only have the retirement money, now you have a different question to ask yourself. Look, I want to, invest in these assets that I know best. And in this case, we're using an example of private equity. So I know private equity better than the stock market, for example. Do I want to invest in market correlated assets, or do I want to invest in alternative assets, assuming that those are the assets that you understand and have your head wrapped around? So that's a different question. Mm-hmm. Is it the stock market or alternative assets? Mm-hmm. Are you going to invest personally or with your IRA or with your retirement account? These are questions you need to ask yourself. Where are you going to get the best bang for the buck tax-wise? Mm-hmm. Now, sometimes in real estate, you get the most bang for the buck buying it personally, because there's so many write-offs to buying real estate personally. Mm-hmm. And that could be the case, but you don't know if you don't just pencil it out. Mm-hmm. or meet with your CPA and get some financial advice, right?
Yeah. And I think there's some people that would say to this, well, I don't want to put my retirement stuff in anything that would be high risk, that I could lose money, because that's my retirement money. I don't want to risk it with that. Well, I would just say, and I would love to hear your feedback on this, Kaaren, if you really think that there's a high probability of losing money, probably not a good thing to put in your IRA. It may also be not a good thing to be investing in personally, unless it's like, really, it's your play money, or it's only a certain percentage, right? So if you're having that conversation with yourself, you might reconsider. You ladies know I'm super, super conservative. So if I'm having that conversation with myself, I'm not going to invest it in anything. Right? If I feel like I can invest in it, then it's something I could do in my IRA, right? And you know what? The stock market is not a guarantee either. People lose money in the stock market every day of the week, unfortunately. So just because it's in the stock market, it's something that people understand. It's something that you have quick liquidity, right? You can make decisions with the push of a button. Doesn't necessarily mean that it's protecting your money.
That's right. That's exactly right. And so you have to obviously make wise choices about investing to begin with. And then it's what vehicle are you going to use, and what's your tax situation? What are your tax benefits going one way or the other? You just want to pencil it out, pros and cons. And it's you can simplify your decision-making process that way. But Another thing that is so important to touch on is, now I'm breaking so that we can reboot because you're frozen. It's due diligence. We have to do our homework on these investments. I've seen obviously thousands of deals go through, our office here. And you need to take a look as an investor at the actual asset itself. Read the contract. I think if you're going to be investing large sums of money, like 50,000 at a pop, you want a second set of eyeballs on that, unless your money means nothing to you and you just like to throw it away. Said no one ever, you definitely want a second set of eyeballs on that. And for example, I was about to invest in something and I showed it to my attorney and he said, well, wait a minute, this and this. And so I just let the asset sponsor know and I didn't realize that, and they fixed it, So don't think that asset sponsors aren't amenable to altering the contract if you've got a good point to make. And also too, you want to make sure, like if you're buying something that's secured, like if you're purchasing a property, or I say making a loan, like a deed of trust, and you've got a security instrument. Okay, so deed of trust, that you've got a mortgage or a loan and a deed of trust. And then we need the security instrument too. And is the security instrument included in the deal? So I think it's always worth a couple $100. Give it to your attorney, have them look at the deal before you invest, and ask them, would you do this deal? Would that person, that attorney, that legal expert who's, hopefully an expert in contract law, invest given what they know. And then on the side, you're Googling the people and you're saying, hey, this person and the word fraud after. Has this person ever committed fraud? You could save yourself so much grief if you find out, oh, guess what? They stole $6 million from somebody and now I'm about to give them, more. So I don't think I'll do that. Mm-hmm. And that does happen. Sadly, often it happens. So due diligence and a little bit of homework makes sense. If an asset is governed or regulated by the Securities and Exchange Commission, then there's a lot of data and several website resources where you can go to find out if you're working with a bad actor. Mm-hmm. And you definitely want to find out that in advance. But say, for example, you do all your homework. Maybe it's a private equity, we'll say, because that's governed by the SEC, and your IRA invests in this Reg D offering. Check the people out, talk to their previous investors. They had a great return, super happy, and they're clean. Their license is clean. You look that up on a FINRA website or NASA with an extra A, the Securities Administration Association. And they look all clean, but guess what? Now you're into this deal and it's going forward as a private equity deal. And all of a sudden something happens and it turns into a Ponzi scheme because the asset sponsor tried to cover things up. You don't know that up front. So every once in a while, you ask for audited financials, and make sure it says that in the private equity deal, that you're entitled to, that they have audited financials, and that you're allowed to look at them so you can check it during the investment to try to see if there's anything going on, and maybe you're not, a forensic auditor or something, but you can certainly talk to somebody who is. Right. And get their opinion. So these are some ways to protect your investments and to do your due diligence.
Got it. I love that. Okay, Kaaren. So that was so amazing. Thank you so much for all that you've offered so far in the show. That was awesome.
Thank you. Hey, it's a privilege to be able to share this information so people can grow their retirement. That's what we want.
I just love that. So Kaaren, you're so amazing. We all love you. How can people reach you?
Oh, well, the best way is uDirectIRA.com, our website, and you can click and schedule a consultation. You can read our free report that's out there to learn about some different asset classes, lots of information there, or you can email us at info@uDirectIRA.com, and we will give you a free consultation. We'll say, tell us about your deal. What are you looking to do? And then we'll discuss that with you, and then you can make your decisions about if that's the right thing for you.
Right. And you also offered earlier that if you go to info@uDirectIRA.com, that you'll give us a list of
Non-recourse lenders.
I don't know why I can't remember that. I was a lending professional. I don't know why, but it's non-recourse lenders. So you can ask for that too. Thank you for that, by the way.
Absolutely.
Yeah. So ladies, I'm really excited. We are going to talk an extra about how to do your due diligence on investments that you want to do in your self-directed IRA. So stay tuned for that and extra. If you're already subscribed, you're going to get it right after this. But if you're not and would like to go to realestateinvestingforwomenextra.com, and then you can get all that information on doing your due diligence. It's a little bit different the way that Kaaren talks about it, because she's talking about it as far as putting it in a self-directed IRA, right? So I'm really, really excited about that conversation. But for those of you that are leaving us now, thank you so much for spending this time with Kaaren and I. You know how much I appreciate you, and I look forward to seeing you next time. And until then, remember, goals without action are just dreams. So get out there, take action, and create the life your heart deeply desires. I'll talk to you later. Bye.
I hope you enjoyed today's show. If you'd like to find out more about how to become a blissful millionaire, go to blissfulinvestor.com. See you next time.